Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. Welcome back to the show, Tim.
Jim, and thank you as always for having me.
Hope Santa was generous?
Oh, yeah, it's come and gone. We don't make a big deal out of Christmas, but I'm glad to see it come, glad to see it go.
We wonder, did Santa have anything to do with the markets? The Dow one day going down a record Christmas Eve, and then on Boxing Day, the day after Christmas, going up 1,000 points. What's going on with the market?
Well, it's the cycle. It's the setup. It's everything we've been watching this year falling together, falling into place, I should say. And, the last time we spoke, I think was December the 13th. And we've talked all year how this higher degree setup's been falling into place and how the industrials have been the lagger. And, all of the foreign markets, and we've gone through the list, and various sectors have been leading and that the dollar had bottomed and all this kind of stuff. We've talked about that. And, as of our last interview, the industrials were starting to play catch up just a little bit. But then the following day, right after our interview on the 14th, we actually had a primary bearish trend change according to Dow theory. Like I said, the next day on December the 14th. And then since then, we all know what has occurred. The market has been down fairly heavily. We found a short-term bottom yesterday, and here we are again down today. I think we're at a short-term low where this could last a little while, but I think it's short-term, and then more of the same. The setup is in place.
You were saying the mainstream media has been doing its best to cover up what is a decline in the markets.
Well, I had the day the Dow theory primary bearish trend change occurred. It was kind of funny. I happened to be sitting at my desk, an email came in, and somebody, a subscriber actually, who knew what was going on from reading the material, they said, hey, there's somebody on one of the mainstream business shows saying that Dow theory, there's not a, disputing the day that it was occurring. And I wasn't even aware at the time that it was occurring. I had to look at it. This brought my attention to it. I actually had to look at the chart. And he said that somebody, a Dow theory expert, was disputing that there was a Dow theory so-called sell signal happening that day. And the irony of it is that it was the exact day that it was happening. And so, yeah, I think they're trying to, to fight the decline by any and all means necessary.
Is that because all the people who do their advertising on those stations are telling them, look, you got to prop us up?
I have no idea why. It's just, I have no idea. I joke, but I mean it. I don't believe much of anything on the mainstream media other than the time and temperature. I don't know. That's a perfect example. I mean, there was obviously, I don't know, maybe the word plot may be a little heavy, but it fits. There was a scheme to dispute what was happening. And, so I don't know why, but that's a fact.
Is it that they feel perhaps that they won't have any viewers if they don't always pump out a very positive message, even if it's not the right message at the right time?
I think it's more about wanting to keep this market afloat, wanting to keep the bubble going, keep the illusion alive. I think that that's more the case. But again, I don't know what's going on in someone else's mind. But I speculate that it would be, just in part of the game and keeping it going.
So your view, which you feel is much more accurate, your view on it?
My view is that, Dow theory stands on its own feet. The cyclical work and statistics stand on its own 2 feet. This has been a very extended market cycle, I should say, because of that kind of thing, because of the jawboning, because of the intervention and so forth. Yes, no question, it has stretched and skewed and distorted every historical norm. No question about that. But you don't get away with that forever. I mean, the cycles do snap back. That we have been watching this setup fall into place, and now that it's in place, and at some point, control will be lost, and maybe we're there. Maybe we're not all the way there, but I think that's where we're going. And I think that's the threat maybe that is being felt is that, they don't want to lose control of this because they know the consequences. I mean, why would you come out if everything's so, think about it logically from the other side, if you will. If everything's so lovely and great, why all the manipulation? Because obviously, it's not so great. And obviously the consequences are known. And so I personally think it's a great disservice to tell somebody something that is the exact opposite of what the reality is. It's kind of like leading them to the slaughter.
Well, I also look back, when the last crash happened, business television really hadn't developed all that much yet 10 years ago.
Well, they certainly, look, there have never, business television, I mean, it's a matter of record, and I've observed it. And you can go back. I've got a book in the 1920s from the quotes of different business people, who, I don't know, politicians, and I mean, it's just quote after quote after quote after quote. And it's not just the modern times. It's just, I don't know, I guess it's just human nature. I really don't know. But they didn't tell or warn. They told people all throughout the late 1929 into 30, 31, 32, all the way down that things are great. It couldn't be better. I wish I had the book in front of me. I could give you some quotes, but it's fascinating to read through the quotes and the propaganda that was spouted during that time. And you look back into 2006 and 7 and into the housing bubble in 2005. Did anybody get on mainstream TV and go, oh, this is a housing bubble? And, no. Because, I mean, by nature, it can't tell you the truth. In 2002, at the 2000 top, as we were making that 4-year cycle top, I had an article come out in Stocks Commodities Magazine explaining where we were going. And I missed the target by 200 points. The market exceeded my target by 200 points. So my target was hit. I said we were going below the 1998 4-year cycle low, which we did. And I presented that information to one of the mainstream financial networks. They read the article, I actually talked to them, and they told me, I can't have you come on and say what you have to say. So I know. And then you look at 2006 and 7, and like I said, the housing bubble and that finally peaked in 5. Did anyone on mainstream media get on and warn or talk about that? There may have been some lost voice somewhere, one or two, but by and large, no. And the same thing with the top in 2007. As the cycle stretched, I warned and said, look, this is an extended cycle. This isn't real. And hey, you know what? We're going below the 2002 low when it burst. And we did. And it was the worst financial crisis since the Great Depression. So by nature, for whatever the reasons may be, they're never going to get on TV and tell you those things. So don't look for that.
We'll have more with Tim Cyclesman Wood right after this.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZB. For more information, please visit us at powerbandsolutions.com.
Welcome back. We're speaking with Tim Cycles Van Wood. Tim, what's the real story behind rising interest rates?
Well, something that, I don't know, this is probably, sometimes what was the old saying? You tell the lie often enough and, people begin to believe it. And then when they see or hear the truth, they've been told the lie and they bought the lie so long that they don't know to recognize the truth, or when you tell them the truth, they think you're the idiot.
Yes, it was Hitler's propaganda minister.
Yes. Well, and I was paraphrasing it, but yes. And it's the same sort of thing with interest rates. The fact is, and when I say fact, I mean fact because you can take the raw data, which is a matter of historical record, and you can overlay the two in the chart, or you can drop it in a spreadsheet, and you can look at the data, which I have done, and I have the data going back into the 1940s, early 40s. And the fact of the matter is that the Fed does not lead the interest rate hikes and cuts. The market does. The Fed follows, and that's a fact. That sounds bizarre. Most people will go, but no, it's absolutely 100% true. And, that's part of the control, and the jawboning is that illusion of control with the Fed. And so, to give you some examples, and I don't know if this will help, but I looked up some things because I wanted to talk about this. But in 1954, going back in time with some, like I said, to show some examples, interest rates rose from 0.6% to over 3.6%. And during that time, there was a 4-year cycle low in equities in 53, and into 1956, over a 2.5-year period, equities were up over 118%, while interest rates went from 0.6% to 3.6%. The same sort of thing happened in 1957, 58. Interest rates bottomed in 58. They went up to like 4.5% from less than or right around 0.5% during that time. The market equities, they rose from out of a 4-year cycle low, and they were up some 56%. We see that time and time again. I don't want to bore you with the details, but in 1962, there was the same sort of thing. In 1966, interest rates bottomed in 67 at around 3.5%, and they rose to 6% during that time. Equities moved to a new high, out of the 66 4-year cycle low. Now, that was during that 66 to 74 bear market period, but still, the point is interest rates rose, the market rose. And so, until where this inverse relationship changed, or this relationship with interest rates, or perceived relationship change, was coming out of the 1974/82 bottom. In 1974, we had, of course, the great bear market bottom that ran from 66 to 74. And during that period, interest rates spiked following that low, interest rates spiked from 5% to 17%. And, that was the bear market bottom that launched the rally. The market never went below the 74 low during that. But from that point, from that 82 bottom, where equities really took off, there became an inverse relationship, or perceived, well, it was real. It's real, but it's not real. There was an inverse relationship generally with interest rates in equity markets because of the direction the cycles were moving. The cycles are out there doing their thing, and sometimes there's an inverse relationship with something, and sometimes there's not. But what it is in reality is it's the cycle doing its thing. Well, where I think we're at is that the longer term cycle in interest rates, I think it's bottomed or bottoming. And I think what we're going to probably see, or what we're headed for, is something similar to that 29, 30, 31 period where we had, coming out of the into the 29 top, interest rates initially rose, and then when the trouble with equity markets began, they initially declined. But then once the seriousness of the situation was recognized, interest rates spiked. It spiked pretty good. And I think that's the kind of thing that we're headed for a little further down the road. But in the short term, what prompted me to think about this again actually was that I saw some posts and people were talking about how the problem with the market was simply because of the Fed raising the interest rates. And that's not, it's true because it's the illusion, but in reality it's not true because what the Fed is, it's the market being the market. The Fed they're simply following the short-term T-bill rate. Right now they're chasing about a 3/4 point spread. And you can watch the 3-month T-bill rate. If we get much above or right around 3/4 of a point, yeah, they're going to raise. Absolutely. And so I'm not defending the Fed. I'm just saying it's not because they raise rates. It's because the cycles are doing what the cycles are doing. Interest rates are going up. The big bubble top that we've been talking about all year has been in the process of peaking, and we're there. And now it's all coming to fruition. It's a matter of the path that we take and how it, what's the twists and turns that take us down this journey to the unwinding of this bubble. But I think we're there. And the point really with interest rates is that I think, like I said, we're not all the way there, but we're going to get to the point to where the illusion with interest rates and manipulating the market with interest rate hikes and cuts that is an illusion in and of itself is going to lose its effectiveness, is what I'm trying to say, as we move into this period, I believe.
We'll have more with Tim Cyclesman Wood right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, a question for me based on a listener question. Is this market like the one we saw in 2000, 2002?
No, I don't think so. Or at least that's my expectation going into it. Because I'll answer the question directly in just a minute. But coming into 2000 or following the 2000 top, that's where the funny business really began with the manipulation and the illusion of manipulation. Like I said, part of it's real, part of it's an illusion, part of it's the illusion of control. That's the illusionary part. But that's where it all began. And then we coming out of the 2000 top into the 2002 low, we saw interest rates move down. Fed cut interest rates accordingly. Then we saw, the big bubble into the 2007 top. And then coming out of that low, we saw, even more that's where we saw the QE and the real liquidity, in pumping the market up and trying to keep the thing alive. In both of those cases, though, it was a downside piece of a 4-year cycle. It was an extended 4-year cycle up, and then the market snapped down, and the whole decline was just one, the remaining downside piece of that cycle into that low in both 2002 and 2009. This time, that's not what I'm expecting. I mean, it could, as we move along, like I said, it's the path we take that could change. But what I think we're going to see this time is I think we've probably got to a more significant top, and I think we see the downside piece of this 4-year cycle, and then probably at least one more complete 4-year cycle within this bear market period. So I think it's going to look more like the 66 to 74 period, or the 29 to 32 period, in which there were multiple cycles within the secular bear market period. And overall, the reason, again, not to digress too much, but the reason that I think that we got here in the first place was, with all the monetary policy and that sort of thing, was the fighting the deflationary forces that began trying to take hold in 2000. And like I said, that's pretty much out in the open. I mean, you can look at the speeches and listen to the Fed speeches and so forth, and they're openly talking about the fighting of the deflationary forces. And I think that we're at the point where they may begin to lose that battle.
Tim, thank you so much for chatting with us.
Thank you.
Have a great New Year's.
Yes, sir.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet, our YouTube channel, Talk Digital Network. If you have questions for Tim or any of our other guests, you can send them to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.